Let me paint you two pictures of the same person at age 65. Picture 1. They spent their 30s upgrading their lifestyle with every raise. Nicer car, bigger apartment, more subscriptions, more dining out, more of everything except investments. At 65, they have a salary history and a retirement account that is 30 years behind where it needs to be. Picture 2. Same income, same city, same opportunities. But in their 30s, they quietly made 7 specific investment moves. Nothing dramatic. Nothing that required a windfall or a lucky break. Just 7 deliberate decisions made consistently over 1 decade. At 65, they have complete financial freedom, and they achieved it before most people even start thinking seriously about money. The only difference between those two people is not intelligence, not talent, not luck. It is a list, 7 investments, made before 40. And today, Kasongo is giving you that exact list. Whether you are 22 or you are 39, this video is going to show you exactly what to do with every dollar you have available to invest, and exactly why each one of these 7 moves matters more in your 30s than at any other decade of your financial life. Stay with me. This is the video that changes how you see your next 10 years. Before we get into the 7 investments, I need you to understand something about timing that changes everything. Your 30s are not just another decade. In the context of wealth building, your 30s are the most leveraged decade you will ever have. And here is why. In your 20s, you are typically earning less, learning more, and building foundational habits. In your 40s and beyond, your financial decisions have meaningful impact, but the compound effect has less time to work. Your 30s sit right at the intersection of earning enough to invest meaningfully and still having enough time for compound interest to do something extraordinary with every dollar you put to work. Here is the math that makes this concrete. $1,000 invested at age 30 at an average 8% annual return becomes approximately $10,000 by age 60. That same $1,000 invested at age 45 becomes approximately $4,000 by age 60. Same $1,000, same return rate. But 15 fewer years of compounding produces 60% less wealth. Every year you delay costs you more than the year before it. That is not a scare tactic. That is mathematics. And it is exactly why the 7 investments we are about to cover matter so much more when made in your 30s than at any other time. Now let us look at all 7. Investment number 1. Low-cost index funds. And I am starting here because this is the single most powerful wealth-building tool available to the average person and also the most consistently underestimated. An index fund is a type of investment that tracks a market index like the S&P 500. Instead of trying to pick individual winning stocks, you buy a small piece of the 500 largest companies in America simultaneously. When those companies collectively grow, your investment grows with them. The data on this is overwhelming and humbling for anyone who thinks they can do better through active stock picking. Over any given 20-year period, low-cost index funds outperform approximately 90% of actively managed funds. Not because the managers of those funds are bad at their jobs, but because fees, taxes, and the difficulty of consistently predicting the market erode returns in ways that the simple index fund approach simply does not have to deal with. The specific funds most millionaires use in this category are simple. VOO or SPY tracking the S&P 500. VTI covering the total U.S. market. VXUS for international exposure. These 3 together can form a complete investment foundation that requires almost no ongoing management and has historically returned 7 to 10% annually over long periods. The action step is straightforward. Open a brokerage account if you do not have one. Set up an automatic monthly contribution to a low-cost index fund. Then leave it alone and let compound interest do the work your savings account never could. Investment number 2. Tax-advantaged retirement accounts. And this one is not just an investment. It is a legal mechanism for dramatically reducing the amount of your money that goes to taxes while simultaneously building wealth. And most people are not using it anywhere near its full potential. Here are the accounts that matter most. The 401k through your employer is the starting point. If your employer matches any portion of your contribution and you are not contributing enough to capture that full match, you are leaving free money on the table every single paycheck. That employer match is an instant 100% return on whatever they match. No investment in the world reliably produces that. The Roth IRA is the second account every person in their 30s should understand deeply. You contribute after-tax dollars today. Your investments grow completely tax-free inside the account. And when you withdraw in retirement, you pay 0 taxes on any of the gains. 0. For someone in their 30s with decades of compound growth ahead, the tax-free growth advantage of a Roth IRA is worth tens of thousands of dollars over a lifetime compared to a standard taxable account. If you are self-employed or running a side business, a solo 401k or SEP IRA gives you contribution limits that dwarf the standard employee accounts and create significant taxable income reduction in the years you use them. The bottom line on this investment is simple. Every dollar you invest inside a tax-advantaged account works harder than the same dollar in a taxable account because it is not being eroded by taxes on dividends, capital gains, or growth along the way. Max these accounts before putting a single extra dollar in a taxable brokerage account. Investment number 3. Real estate or REITs. Real estate has created more millionaires throughout human history than almost any other asset class. And the reason comes down to one word that does not exist in the stock market in the same way: leverage. When you buy a property with a mortgage, you are controlling an asset worth $300,000 with perhaps $60,000 of your own capital. When that property appreciates in value by 10%, that 10% applies to the full $300,000 value, not just your $60,000 down payment. That is a $30,000 gain on a $60,000 investment, a 50% return from 10% appreciation. This is the math that makes real estate so powerful as a wealth-building tool. Now, I understand that not everyone in their 30s is in a position to buy an investment property. And that is completely fine because there are 2 other paths to real estate exposure that require far less capital. House hacking is where you purchase a small multi-unit property, live in one unit yourself, and rent the others. Your tenants essentially cover your mortgage while you build equity in an appreciating asset. Many people achieve this with a down payment as low as 3.5% through FHA financing. REITs, or real estate investment trusts, are companies that own and operate income-producing real estate and trade on the stock market like regular shares. You can invest in real estate through your existing brokerage account, starting with as little as $10. VNQ is the most popular REIT ETF and gives you broad exposure to the real estate sector while paying quarterly dividends. The key is to get some form of real estate exposure in your 30s. The compounding of appreciation plus rental income plus mortgage paydown over 20 to 30 years is a combination that very few other assets can match. Investment number 4. Your own business or equity stake. And this is the one that separates millionaires from high earners most dramatically, because there is a fundamental ceiling on wealth that you run into when your only financial relationship is with a salary. And that ceiling does not exist when you own equity. Here is the core distinction. When you work a job, your income is linear. You trade hours for dollars at an agreed rate. When you own a business or an equity stake in one, your income is tied to the value you create in the system, not the hours you put in. And systems can scale in ways that individual hours cannot. Now, I want to be honest about what building a business in your 30s actually looks like in reality. For most people, it does not look like quitting your job on Monday and launching a startup on Tuesday. It looks like building a side income that generates $500 to $2,000 per month initially, then systematizing that side income so it requires less of your time, then scaling it as you learn the market and your own capabilities. The smallest viable business is a single skill packaged and sold to a specific audience at a price that makes the math work. A freelance service, a digital product, a content platform, a local service business. None of these require significant startup capital. All of them can be started around an existing job in evenings and weekends. The reason this investment belongs in your 30s specifically is that your 30s give you the combination of enough earned income to fund the early stages of a business and enough runway ahead to let that business compound into something that could eventually replace and far exceed your salary. The wealthiest people in the world are almost universally business owners or business investors. Not because business is the only path, but because ownership creates the kind of asymmetric upside that employment structurally cannot. Investment number 5. Skills that increase your earning power. Warren Buffett has said repeatedly that the best investment you can ever make is in yourself. And the math on this statement is more compelling than almost any financial return you will find elsewhere. A skill that increases your income by $10,000 per year is worth more than most people's entire investment portfolios at the start of their 30s. Because that $10,000 annual income increase, invested consistently over 30 years at average market returns, compounds into well over $1 million. The skills that produce the highest return in the current economy fall into 4 categories. Technical skills like software development, data analysis, and AI tool usage. Financial skills like understanding tax strategy, investment analysis, and business finance. Communication skills like writing, public speaking, and sales. And leadership skills like managing teams, systems thinking, and strategic decision-making. What makes this investment particularly powerful in your 30s is the combination of timing and application. A skill you develop at 32 has potentially 30 or more years of compounding income potential ahead of it. The same skill developed at 50 has 20 years or fewer. And the cost of most skill development today is genuinely low compared to the return. A $500 course that helps you command $2,000 more per month in freelance income produces a 400% return in the first year alone. No stock in the world reliably produces that. Invest in at least one significant skill upgrade per year throughout your 30s, and watch how dramatically your income trajectory changes by the time you reach 40. Investment number 6. Dividend-paying stocks. This is the investment that most people in their 30s do not think about until much later. And starting it earlier than most people do is one of the quietest and most powerful advantages a wealth builder in their 30s can have. Dividend-paying stocks are shares of companies that distribute a portion of their profits to shareholders on a regular basis. Usually quarterly, sometimes monthly. You own the shares, the company profits. A percentage of those profits flows directly into your brokerage account on a schedule, regardless of whether the stock price goes up or down. The magic of dividend investing in your 30s, specifically, is what happens when you reinvest every dividend payment back into more shares. This is called DRIP or Dividend Reinvestment Plan. And the compound effect of doing this for 1, 2, or 3 decades is genuinely staggering. Here is a simple illustration. You invest $50,000 in a diversified dividend portfolio yielding 4% annually. That generates $2,000 per year in dividends. You reinvest all of it buying more shares. Those new shares generate their own dividends, which buy more shares. Over 20 years at consistent reinvestment and modest appreciation, your original $50,000 investment can grow to well over $250,000 with the dividend income continuing to climb the entire time. The best dividend ETFs for building this position include SCHD, which tracks high-quality dividend growth stocks, VYM, which focuses on high-yield dividend payers, and VIG, which tracks companies with strong records of growing their dividends over time. Starting this investment in your 30s gives the DRIP compound effect maximum time to work. The people who build significant dividend income in retirement almost always started the position far earlier than felt necessary at the time. Investment number 7. An opportunity fund. And this last one is the most underrated item on the entire list. So I want you to stay focused here, because understanding this concept separates average investors from genuinely wealthy ones. An opportunity fund is a dedicated pool of liquid cash, typically 3 to 12 months of living expenses or more, kept separate from your emergency fund and your regular investments. Its entire purpose is to be available when an exceptional opportunity presents itself. Here is why this matters so profoundly in your 30s. Your 30s are the decade where opportunities begin appearing in your life that your 20s did not have access to. A friend launches a promising small business and needs an early investor. A real estate deal appears at a below-market price requiring a fast cash offer. A business acquisition opportunity presents itself. A once-in-a-decade market correction drops quality investments to prices that will not be seen again for years. Every one of these opportunities has something in common. They reward the person who has capital available immediately and penalize the person who has to scramble, borrow, or simply watch the opportunity close while they figure out their finances. The people who build the most wealth in their 30s and 40s are almost never the ones with the highest salaries. They are the ones who were liquid when everyone else was fully invested with no room to move. Who had cash when the market panicked. Who could move fast when others moved slow. Building an opportunity fund is not about being conservative. It is about being ready. The best investments you will ever make might be the ones you cannot predict right now. The opportunity fund ensures you are never in the position of having to say, "I wish I had the capital available when that came along." Keep this fund in a high-yield savings account or short-term treasury bills where it earns competitive interest while remaining fully accessible when you need it. Now let me show you what happens when all 7 of these investments work together simultaneously over a decade. This is where individual investments stop being separate decisions and start becoming a wealth-building system. And systems produce compound results that no single element could produce on its own. Consider this realistic scenario. You are 30 years old, average income, no special advantages, but you make a commitment to all 7 investments in the following proportions. You contribute to your 401k enough to capture the full employer match. You max your Roth IRA annually. You invest automatically in low-cost index funds every month. You start a small side business that generates $500 per month in its first year. You take one significant skill development course per year. You begin a small dividend position and reinvest every dividend. And you build a 3-month opportunity fund in a high-yield account. At age 40, what does this look like? Your index fund position has grown to a meaningful portfolio with decades of additional compound growth ahead. Your retirement accounts have grown substantially with tax-free or tax-deferred gains accumulating. Your side business has likely grown significantly from month 1. Your dividend income is now contributing hundreds per month that buy more shares automatically. Your skills have made you substantially more valuable in the market. Your real estate position has appreciated and possibly generated rental income throughout. And your opportunity fund has already allowed you to take advantage of at least 1 or 2 opportunities that your peers had to pass on. None of this requires a windfall. None of it requires exceptional talent. It requires one thing that most people underestimate enormously: a decision made in your 30s followed by consistent execution for 1 decade. I want to speak directly to the people watching this who feel behind, who are in their 30s and feel like the window has partially closed, who look at this list and feel overwhelmed by how much they have not yet done. First, I want to say this clearly. The feeling of being behind is one of the most common feelings in personal finance, and it is almost always more subjective than objective. Most people feel behind, regardless of where they actually are. Second, I want to be honest with you about something that tends to get lost in financial content. Starting at 35 is dramatically better than starting at 45. Starting at 38 is dramatically better than starting at 48. The window has not closed. It has simply started producing less optimal results with each passing year you wait. Which means the single most valuable thing you can do right now, today, is start. Here is the order I would recommend if starting from scratch with limited resources. Step 1. Capture any employer 401k match immediately. This is your highest guaranteed return. Step 2. Build a 3-month emergency fund first. Without this, every investment decision is made from a position of fragility. Step 3. Open a Roth IRA and begin contributing even small amounts. Step 4. Start building index fund investments automatically with whatever you have remaining. Step 5. Launch the smallest viable version of a side income stream immediately. Even $50 per month is a start. Step 6. Commit to 1 skill investment this year. Step 7. Build your opportunity fund over time as your income grows. You do not need to do all 7 perfectly from day 1. You need to start all 7 as quickly as reasonably possible and improve your execution of each one over time. Let us bring everything together. 7 investments every millionaire makes before they turn 40. Investment 1. Low-cost index funds. Your foundation. The wealth-building vehicle that outperforms 90% of professional fund managers over any 20-year period. Investment 2. Tax-advantaged retirement accounts. The legal mechanism that makes every invested dollar work harder by removing the tax drag that erodes returns in regular accounts. Investment 3. Real estate or REITs. The asset class that combines appreciation, rental income, tax advantages, and leverage in a way no other investment category matches. Investment 4. Your own business or equity stake. The path to asymmetric upside that employment structurally cannot provide. Investment 5. Skills that increase your earning power. The investment with the highest and most reliable return available to any individual in any economic environment. Investment 6. Dividend-paying stocks. The compound machine that rewards patience and reinvestment with growing passive income that funds itself over time. Investment 7. An opportunity fund. The liquidity advantage that puts you in position to say yes when everyone else has to say not right now. 7 investments. 1 decade. The difference between financial freedom at 50 and financial anxiety at 65. Here is what I want you to do before this video ends. Look at the list of 7 investments. Be honest with yourself. How many of the 7 do you currently have in some form? And which one are you missing that should be your very next move? Drop that answer in the comments below. Tell me which investment you are starting this week and where you are in the journey. I read every single comment on this channel, and I will personally reply to yours with specific guidance for your situation. And if this video gave you a clearer picture of what your 30s should look like financially than anything else you have found, share it with one person in your life who is in their 30s or approaching them and has not yet started building this foundation. One share from you could genuinely change the trajectory of someone you care about. Subscribe and hit the bell, because next week we are going even deeper on the specific account every millionaire has that most people have never heard of. That is a video you absolutely will not want to miss. This is Kasongo. Make the investments, build the foundation, own your future, and I will see you in the next one.